going to go ahead and start. Our speaker today is Jarrad Harford from the University of Washington. Jarrad received his PhD from Rochester in 1998 and took his first job at Oregon. In 2001, he went to Washington, where he's been there ever since. And he's now a professor of finance there. Jarrad has a very high percentage of his articles came out in the Journal of Financial Economics. And his first publication was 99, and since then he has 7 JFEs, which is a pretty nice hit rate. His 1999 Journal of Finance article has over 60 sites on Web of Science, corporate cash reserves and acquisitions. And in his spare time, apparently, Jarrad is also quite a good teacher. He received teaching. So we're very pleased to have him here today.
Well, thanks. Thanks for having me. My family and I have been enjoying in New Zealand, and now I get to do a little bit of work and do some of what I enjoy, which is talking research and getting some comments. This paper, as you can see, is joint work with Dirk Genter, who's now at Stanford, and Kai Lee, who's at University of British Columbia. And we're kind of we're in the midst, despite being kind of spread out right now, because Dirk's in I think he's on holiday in Bulgaria, and Kai's in Canada, and I'm here. We're attempting to do a revision of this paper. So this is a well-timed talk from that standpoint to get some comments as we go into the revision. So just to give you a motivating and kind of setup example here. We're dealing with what we're calling, as you see on the previous slide, we're calling these shareholder cross holdings. And there's kind of two parts to this paper, as you'll see as we go through. First is just talking about cross holdings in general, and then specifically talking about what's going on in acquisitions. The reason we pick acquisitions is they're sort of they're large enough and the effects are big enough to really kind of get a sense of what's going on in acquisitions. And as this example sort of makes evident, so this is Tribune's bid for Times Mirror. These are two large newsprint groups, magazine and newspaper groups in the U.S. March 2000, the Tribune shareholders thought it was a horrible idea. It was a big premium for the Times Mirror shareholders, so their stock price reacted quite positively. But then the question is sort of, okay, bidder shareholders, how does it affect them? Well, just take the top, whatever I have here, 8 or so investors in Tribune. Here's their holders of Tribune, and of course the effect on their stock in Tribune, their holdings in Tribune is fairly straightforward. Their holdings in Tribune went down by 11%, and the value of their holdings went down by 11%. But they had very different total outcomes from this 3-day effect because they held very different amounts in the target in Times Mirror. And so the top one, which had 4.3% MS investment, had 4.3% in Tribune, nothing in Times Mirror, and so they did suffer the full 11% loss on the transaction. Barclays, however, actually had a larger stake in Times Mirror than it did in Tribune, and once you work out the actual total effect on their portfolio, they actually ended up benefiting from the transaction, from the announcement of the transaction, and so forth as you go down. You see some of these. Fidelity had twice as much in the target as they did the bidder, and so they were quite happy overall with the announcement, even though some of their fellow shareholders in Tribune were losing 11% on the deal. And so, the basic idea here is that because of these cross holdings, because they're holding both the bidder and the target, there's heterogeneity amongst the shareholders in how they're affected by the deal, and that kind of creates a situation where it's unclear how management should proceed, because sort of any firm level decision rule will end up favoring one set of shareholders over another, which is a little bit different than we sort of normally think of as, well, you just maximize value of share price, all shareholders are happy with that, but there's externalities being created here, and different shareholders are affected differently by the externalities. So that's the sort of motivating example. Getting back to the general idea of the paper, we're used to the idea of direct corporate cross holdings. In Europe and Asia, they're very common. What we're talking, we call them cross holdings for lack of a better term. We're talking about sort of indirect, in that instead of the firm holding shares in the other firm, it's your shareholders are holding shares in the other firm. So it's similar, except that each shareholder has a different cross holding then. And we're looking, of course, at U.S. data. That's what we have, so we're looking at and we have U.S. data on institutional holdings. And so then, because you're internalizing these effects on other firms at different rates, then you have this heterogeneity in shareholder preferences over managerial decisions. Okay? And so this is sort of a general problem, is that a lot of firm actions will create these externalities, and there'll be different preferences over these firm actions. We're going to, after we talk about this in general, we're going to look at the specific problem of the acquisition setting, partly out of convenience for ourselves, because in that case, not only is the externality large and measurable, we can measure what happens to the target stock price, but we have the data, and if anything's going to matter, it's going to, we should be able to pick it up there. And so we're going to basically start off the paper by talking about how large are these cross holdings in general, what determines them in general, and then do they influence managerial decisions? And the specific decision we'll look at is M&A. Yeah, Jim.
In the broader sense that you're talking about here, when you're calling it cross holdings, I'm thinking of it more like portfolio holdings.
Yeah.
Large institutional traders. And I mean, when we go to portfolio theory, I'm just trying to put it in that context where,
well,
I assume I hold the market.
Right. So if a CAPM investor would have basically a cross holding of 1, in the sense if it was their ratio, they would hold 1% of every firm, right? And so yeah. And so we'll find that the institutional investors have substantial deviations from that.
But I mean that's in the sense of your general idea here is that firms own these institutional investor firms have holdings in all kinds of different individual firms, and obviously they are impacted that it's not perfectly diversified, and they are impacted by managerial decisions. That's what you're.
Right. The extreme case of the CAPM investors is sort of indifferent, in the sense that they don't care what you pay as your premium or these effects. And of course, in that world as well, every investor has the same cross holding, so there's no disagreement. So what we're saying is, well, yeah, there is different cross holdings, and so there is disagreement when we sort of move it, when we actually see what the reality is. And the first general question is, well, okay, once you're in that, once you realize that, how should managers, or how would managers behave in a world where their different shareholders actually prefer different actions, instead of all shareholders agreeing about that one action is the right action? And then we go into the acquisitions. I don't know if that was a roundabout. Yeah. Yes.
Can you say something about what the legal I'm just struck by the fact that in the numerical example, and that factual example you gave, total capitalization went up. If you owned 100% of both companies, your shares would go up rather than go down. But the company that was doing the buying, their share value went down, suggesting that obviously the market valuation
Oh, you mean, could they affect a merger that was basically a pure wealth transfer from the minority shareholders to themselves? Well, let's see. So let me think. Not being a securities lawyer, I have to think about this a little bit. So they could. So typically, in order to avoid what would surely be litigation and potentially successful litigation, what would happen is that the bidding and the target board, although this would be difficult in this particular situation, would set up committees of disinterested representatives, so the minority shareholders would get to decide. But barring that, I think it would technically be. Say again, I'm not a lawyer, so and I've just found out I'm being recorded. So I believe that technically it would be legal for them to vote this merger through, but they would almost surely be sued under in civil court, and it'd be interesting to see what came out there. But I'm having trouble thinking of any pure prohibition from majority shareholders in the bidder choosing to approve a bid it would be one of these things that's not, I think, explicitly outlawed, but that they would almost certainly lose a civil action on if they didn't appoint a disinterested board committee to actually deal with it. Okay. So again, sort of continuing our discussion of the general issues here. We always talk about, just maximize the value of the firm equity, but of course, and that particularly works if we are in a CAPM world where these cross holdings aren't important because they're all the same for everybody. But the shareholders own portfolios. They aren't all the market portfolio. They're different, and so they have different preferences. And as I said, we choose mergers because it's large and measurable, and bidders impose this large, typically positive externality on target shares, and so depending on the amount of target shares you own, you will have a different preference about what premium should be paid, aggressiveness of the bid, etc., whether the bid should go through at all. So just to start getting a sense of how we're going to talk about these cross holdings, it's similar to the toehold literature in the sense that it's like every shareholder, the bidder, has his or her own toehold in the target. Some of them have a 0% toehold in the target, some of them have a larger toehold in the target. And so our example here is if you own 5% of the bidder and 2% of the target, then you effectively want the bidder management to put a 40% weight on target value. So and here this is sort of relative in the sense that we put a weight of 1 on bidder value and a weight of 0.4 on target value. And so it's effectively as if this is basically very similar to theoretical models of toeholds. So it'd be basically the same as if the shareholder wanted the bidder management to act as if the firm itself had this toehold in the target and was actually receiving 40% of the target's gains. And so under that scenario, if you in this setting where these are similar to toeholds, if you go to the toehold literature, what are they found in the toehold models and the empirical investigation of toeholds, then targets should be more attractive because bidder shareholders capture some of the gains accruing to the targets. Okay, so the general idea that shareholders have heterogeneous preferences over managerial actions because they have different, they are affected differently by the externalities imposed by firm decisions is not new to us. Easterbrook and Fischel, Hansen and Lott, and Amir Rubin has a more recent paper about talking about, in general, the effects of shareholder diversification on corporate objectives, and how it's sort of how this just changes the way they view corporate actions because of these externalities. Now, the most closely related paper to ours is this paper by Matvos and Ostrowski. And we were talking about this at lunch. Somebody asked about, what happened when we found out about this other paper, or what was the history there. And, we had started this paper. This came out of another paper that Kai and I had been working on, and Derek had commented on, that had led us to start working in this direction. And then, there's this other paper by Matvos and Ostrowski that is also looking at this cross-holdings effect. They're specifically, their paper is entirely about what's going on in acquisitions and about voting. Gregor Matvos has a large voting database in terms of corporate shareholder voting. And so their idea was, well, we know that on average bidding shareholders lose in acquisitions, and so why do they continue to approve these deals? And so they said, well, maybe it's because we're failing to realize that these bidding shareholders also are getting the other side of the transaction, and they're actually ending up better off, as some of the shareholders did in that initial example I showed you. And then they show some relation between if you're an institutional shareholder and you own a bunch of shares in the target, you're more likely to vote to approve the merger. Now they compute this wealth effect, the fact that this switch in the wealth effect to make the bid a good thing for you, by sort of just aggregating all the holdings of the shareholders that own shares in both the bidder and the target, and show that the total holdings in the target is great. But what they miss in that is that the shareholders that are actually overweighted in the target, that actually prefer overpayment, hold a tiny little stake in the bidder. That's how they end up being overweighted in the target, and they have so they should have very little influence with the bidder. That they're basically adding up. They're saying every shareholder that owns both shares in the bidder and the target, and let's just add up those and see how much wealth effect there is. But basically what they're adding up is there's shareholders that have a lot of shares in the bidder and a tiny little bit in the target, and they get thrown in there. So it looks like you have this large block of shareholders that have a lot of influence with the bidder, that own a lot in the target, but you're actually completely missing the heterogeneity of the relative effects. And as you'll see as I get to our data, the possibility that this is explaining why bad acquisitions get through is confined to a very small subset of acquisitions, where there really is a large fraction of the shareholders that are overweighted in the target. That in the majority of bids, this is just not the explanation. Okay.
Although in the leading example, that was a sense making the case that Matvos and Ostrowski and things was making, right? Because the majority of those institutional investors overall receive positive returns.
Yeah, so that was of course that was an extreme case because the target return was like positive 82%. But also, the largest shareholder had 0% in the target, and so that also that's part of what's going on in our part of the point we're making is that there are substantial blocks in the bidder that are definitely losing. But yeah, in that leading example, you have to go back and add everything up. But if they were to, in a sort of a Coasian world where there were cross payments and they all sort of figured this out, and acted as a block, they might have decided that was not a bad idea. Okay. So overall, what are we going to do? Well, we're gonna first look. As I said, I want to start off general, and just talk about cross holdings in general. So I'll start off with the S&P 500 and also talk about the next 100 to avoid the just pure indexing effect. And we just look at them in 1985, 1995, and 2005 to get a sense of how big are the cross holdings and how they've been evolving over time. And we'll find that they've actually risen pretty rapidly over the last 20 years. And also, we're going to examine sort of what determines cross holdings. You know, why would one pair of firms have larger cross holdings than another? And it basically comes down to the idea that if you think about institutional investors having some kind of investment screen, you know, each particular institutional investor has a particular investment screen, then sort of similar firms are going to rise through that screen. And so the more similar two firms are, the more likely they are to have cross holdings. And then we're going to shift gears a little bit and look at an acquisition sample and see, okay, do the cross holdings, you know, first of all, how big are they relative to the rest of the sample? And then second, do the cross holdings appear to matter in the sense that they affect any part of the overall acquisition deal? So we're going to show that you know, some of them do have large cross holdings in the target. There are a lot of deals where there are large cross holdings, but you know, like I said, this isn't enough to have a massive wealth effect in terms of shifting the voting enough to make these deals go through. But it does appear that bidding management is picking targets, all else equal, that have larger cross holdings. So there will be sort of, you know, you can think of it as there'll be less resistance to this idea, all else equal, because of these larger cross holdings. So a little late to get to the outline, but it's kind of getting preview of the results, and then just where are we going from here. So we're gonna yeah. Question about the outline?
The previous point you made where you said, you know, they're more likely to make merger bids on targets that have cross holdings. But in your earlier statement that similar firms are likely to have more cross holdings. So then the question is, well, do acquisitions or targets picked that are, you know, similar?
Right. So we were concerned about this. So this is even above and beyond this dimension. These dimensions of similarity. Two firms that, you know, are otherwise, you know, two potential targets that are otherwise similar on all these dimensions. The one they pick is the one that has higher cross holdings, even controlling for these other dimensions. And so just to lay it all out there, we'll never really be able to fully put to rest the possibility that there's some unmodeled dimension that both leads institutional investors to hold more shares in this particular pair of firms, and those firms want to merge. So there could be this, you know, this external dimension that is causing that, but we try our hardest to sort of minimize the chance that that's what's going on by trying to capture as many dimensions as possible in our model. Yes, please.
I'm just a little bit confused about the logic. On a few periods research, you disagree with them that institutional shareholders have the influence on managing a decision. But now, for your experiential results, you said the managers do. It's a strong evidence that bidders take the shareholders' cross-holding into account. Then, why does managers take this into account?
Well, so I guess I don't want to make it sound too extreme, our disagreement with Matvos and Ostrowski, because it isn't. Basically, what we're saying is that it certainly appears that managers are aware of these cross holdings, at least in this setting, and we've heard anecdotal evidence that you know, investment bankers will, you know, like to, you know, when they're pitching deals, they sort of circle common shareholders, so that the managers know that, you know, the shareholders in the target are shareholders they're already used to, they already have relations with, so forth. So we think they're aware of it, and then the question is, do they pay attention to it? And we think that there's evidence that they pay attention to it when choosing targets, whether this is because they are purely trying to sort of maximize the wealth of most of their shareholders by doing this, or whether this is because they're simply trying to reduce resistance to their acquisition decisions. We're not really able to decide. And it has some effect on the margin, but Simadvas and Ostrovsky go as far as to conclude that this basically explains how these deals go through, and it's not a large enough effect to explain that. The effect is enough to reduce the resistance of some shareholders, but it's not like 50% or even 20% of the shareholders are rooting for the overpayment or something like that. So that's kind of that's probably the. I see now, as you were asking the question, that distinction was, I didn't make that very well in my remarks, and probably we could make it better in the paper too. Okay, so we're going to talk about this effect, how it's going to. What is the firm's objective function in this situation, where it's not this simple just maximize your own share price. Then we'll get into the empirical stuff, size, determinants, evolution of the cross holdings. We'll look specifically at, is there an effect in acquisitions, and then I'll wrap up. So a sort of short model, or it's not even a model in the paper anymore. I've been cutting back the theory section because it's really just derivative of the theory section in toehold papers. Of what's going on here is that you have a shareholder. They have stakes in both the bidder and the target, and we'll say alpha B in the bidder, alpha T in the target. And so they want to maximize the total value here with weights alpha B, alpha T. We go through it a little more in the paper, but essentially what happens here is that they essentially want a weight of 1 on bidder value and alpha T over alpha B on target value, and that's back to my earlier example where I said, say they have 5% of the bidder, 2% of the target. They want a weight of 1 on the bidder and 0.4 on the target, 2% over 5%. And this is where I was also talking about how they basically that's the same as wanting the bidding firm to act as if it had the same toehold, this alpha T over alpha B. Now the rub is that every shareholder has different alpha T's and alpha B's, and so they don't have the same preference, they don't have the same weighting, and so managers have to choose how to behave in the presence of these different cross holdings. And so they could ignore it and simply align themselves with the concentrated shareholders who have essentially 0 or low cross holdings, or they could take it into account. And there's lots of, this isn't really straw man in the sense that there's lots of reasons to think that they could ignore it. If the concentrated shareholders tend to be the ones that have the larger stakes in the bidders, they might have the lower stakes in the target, and those are the ones that have the most influence. Managers themselves are compensated to behave as large concentrated investors in the bidder. They have options and so forth that put weight of 1 on the bidder and 0 on the target and so forth. And so there's lots of reasons to think they might ignore it, but there's also reasons to think they might take into account once you bring in other possibilities of why they might want to pursue the bid and so forth. Now the trick here is that there's no one simple rule. How should they? What's the objective function? It's this. Boom. There's no simple rule of what the objective function should be in this case. And so, we basically end up presenting a lot of different data with a lot of potential weights, a lot of potential measures of cross-holding. One could, if you think about a simple voting model, you want to retain 50% of the votes. And so you figure out what's the most, what's the the most aggressive policy that at least half your shareholders would approve of. And so, we're going to end up calling this sort of the median shareholder rule, which is sort of this is it. There's the one that has the biggest cross-holding in the target. They're going to be the most aggressive, and you start ranking them from most aggressive down to 0 in the target, and so at some point you get to 50%, and that's the most aggressive you can be and still retain half your votes. And I'm going to shoot forward here just to make this a little bit more clear, because this part is pretty confusing. So what we do is, and we only have data on institutional investors, so we're looking at the fraction of institutional votes held by each institution. So what we do is we rank the sort of votes or stock ownership in the bidder from 0 up to 100% by their relative cross-holding. So if you actually have a larger stake in the target than you do in the bidder, then your cross-holding is going to be over 100%, right? So let's say, in this case, 1% of the shares in the bidder are held by firms that have about 116% or more cross-holding, right? And then we continue along and 20% of the shares are held by firms that have, about whatever this is, 45% cross-holding weight. So they would put a weight of 45% on target value, until you get to the point where 50% of the shares are held by firms that have at least 25% cross-holding or more. And so what we're going to do empirically is that for every firm, for every bidder target combination, and initially for every pairwise combination in the S&P 500, so this is fairly computationally intensive, we're going to take firm A, rank its shareholders by their cross-holdings in firm B, and go and compute, what's the top 1%, what's the top 10%, what's the top 20% down to the median. Yeah, sorry, you have first.
Great stuff. I was wondering if you also run median preference against mean preference, so there'd be some opportunity of side payments.
We do I forget if it's made it into this part of in this version of the paper, but we at one point at least we also computed the full side payments cross-holding, which was sort of the sort of the average, right? Which is sort of everybody who had a cross-holding got together, they made their optimal side payments, and this was the toehold they decided on, right? And it wasn't, it was sort of, larger, but it wasn't large enough to sort of change our conclusions that this is not the biggest thing in town. But yeah.
You need to run them side by side, because there is a literature in voting as to whether median or mean preferences do more in explaining outcomes. And just
Okay.
running them as a horse race would be kind of neat.
Okay, yeah.
And it's a hell of a lot harder to compute a median than a mean on this sort of stuff, so it shouldn't be that.
Yeah, well, we actually already have them. It's just because we did compute them. It's just a matter of using them. I just didn't realize that there was this big, there are weird rules. Some of them were relaxed in the early 90s about communication among shareholders in the U.S. that would make this actual side payment model difficult, if not patently illegal in parts of our sample, but it would still be interesting to check. Yeah, shame. Yeah, so we don't have all votes, all shares, because we don't have the cross-holdings for private. So yeah, so this would be of the institutional shares.
So you maintain the assumption, in effect, is that the non-institutional investors have the same cross-section of cross-holdings.
Right, well, yeah, I guess we could look at it that way. So we in the paper, not as much in the presentation, just for parsimony. In the paper, we present sort of two sets of results often, which is what does it look like in this world where you normalize by institutional investors? And what does it look like if you consider all shares and just assume everybody else has a cross-holding of 0? Which is pretty conservative because the CAPM cross-holding would be 100%. But for the sort of main results of the paper, we focus on this. And sort of our maintained assumption is either the private investors have the same distribution or they are less influential in general. With that the ones that actually matter are the institutional investors in terms of having any chance of influencing the outcome. And so yeah, those are for better or worse. Those are the assumptions we have to make to proceed. Yeah. Okay, so I think I said everything I wanted to say here. So we do this for every firm, every pair of firms, and that's where we get a lot of the base numbers that I'm going to be showing you.
You do end up weighting or something by the proportion of shares held by institutional investors?
Well, we effectively require in a subset of our results, the results that we focus the most on, we require that the bidding firm have at least 20% of its shares held by institutional investors in order to be considered, which, because bidding firms tend to be large and institutional shareholders hold about half of the market overall, turns out to be a very innocuous assumption. We lose like some tiny fraction of our sample by making that assumption.
But you could argue that you want to weight your observations differently because there's more information.
Yeah, it would probably be, because we're doing this normalization, that's a good point, that we could, it would be, yeah, we would lose sort of less information or potentially get, sort of a better measure.
It's a noisier signal on those ones for whom the
right.
institutional investors are smaller.
Right, so basically we've lumped all firms that have 20% with the firms that have 80% institutional holdings, and that's, yeah, we could just do some kind of weighting. Yeah.
I'm still a little puzzled about the incentives of the managers to do any of this, given that you said that they typically, their incentives are to hold 100% in the bidding pool and not to have cross-holdings. Is that the case, that they themselves don't have these kind of cross-holdings?
Yeah, well, we can.
Why do they listen to their shareholders? Is it the guys coming in and saying, oh, I'm going to take on these guys, and they think, oh my God, this is going to screw my shares, my share price.
Yeah, that's reminiscent of a comment I remember getting an early version where a friend of mine said, "Well, we already know managers ignore shareholders, so why should they start paying it? This is more complicated. Why should they pay it?" And so, I think you do have to, you have to throw in some, either you're talking about, there's sort of two possibilities. One is managers do care about their shareholders, and so this would be paying attention to these cross holdings is closer to maximizing shareholder total wealth than ignoring them. Although it does benefit some at the expense of others, but you can still maximize total wealth. The other is more going toward the Matvos-Ostrovsky, but not quite as extreme, in the sense that the other part of their utility function is that they want a larger firm because they're going to eventually get paid more, and that's going to be enough to offset the fact that they have a weighting of 1 on the bidder and 0 on the target. And so they're picking targets because there'll be less resistance, even if it isn't enough to seal the deal. Right.
But as soon as you do something major, like I'm going to buy a company that you already own 30% of, the shareholder sits up and takes notice, and the manager is likely much more responsive.
Oh yeah, I like that. I like that answer. That makes sense, right? Is that for the most part, Yeah, for the most part, and it gets back to why are we looking at acquisitions, because this effect is big enough that the shareholders with the cross holdings aren't going to ignore it, and these are large measurable effects that they aren't going to sleep through this one. So yeah.
James, if you're a manager and you've got all these options in your own firm, and you're going to make a decision that's going to screw your options. I mean, if there's some big institutional shareholder that says, "Come on, I want to get this guy because I got 30% of it," and you've got 0, so you're going to take the minus 11% hit, and he's going to get 20 plus 24.
Yeah, well.
But as it is right now, you wouldn't do it anyway. I mean, on average, these bidders lose money, right? So that's simply the way they're looking at it. They wouldn't be making acquisitions to begin with.
Right. Yeah, and we have a.
I'm saying they wouldn't do it anyway. So this is, you know.
I'm saying the managers don't. I mean, if the managers have the incentives which you described in the first place, that they have kind of options and they're specialized specific to this firm. But I just want maybe the managers cross over too.
Yeah, I mean, there's other work. Some of it that Kai and I have done that has shown that the ex post changes in compensation after an acquisition end up more than make up for their losses on their initial portfolio. So they have an incentive to make the acquisition, and then the question is sort of who do they pick? Right.
That was after 3 days. Is there any data which suggests an overreaction in the short run in terms of loss of value?
If anything, the evidence, which, as with any of these long-run studies, is a little bit controversial because nobody can agree on what the right model is, and whether the asset pricing model is right over the long run. Is that at least in the case of stock acquisitions, if anything, it underreacts. The bidding share price sort of continues to perform rather poorly over the next few years. In cash acquisitions, it's sort of a push. And so the 3 days just going from -1 to +1 in terms of the relative days to the announcement. And so there's not any evidence that that this is on average an overreaction. Managers' response to a really negative reaction to their acquisition decisions is typically that it is an overreaction, that they have, they have information that the market doesn't, that makes them believe that this is still a good acquisition and that their beliefs will be vindicated. But the data don't really support that in general.
So then, okay, now I'm puzzled. Why would the evidence be, other than that the managers have got complete control of the share, that their compensation goes up?
Yeah, no, it's.
Go down, in fact, not losing value for.
It's a sad state of affairs, but nonetheless true. That, and I should say that the paper I was talking about that showed that even when the shareholders lose value, the managers end up better off. Under certain measures of strength of governance, it's that doesn't happen in the better governed firms. So there is some cross-sectional variation there, but on average, firms aren't governed that well, and so you end up with.
Do you know that the institutions stay with these bidding firms to get their investments not sold off? Because
Right.
I mean, my information is I take my money from the target and I'm done.
Right, and we, well, I'll show you in a minute a graph of what happens up to quarter 0. We actually looked forward, and the holdings are remarkably stable, at least going forward a little bit, and particularly on the bidder side. There's certainly anecdotal evidence and even some empirical evidence in Baker, Stein, and Wergler paper on the target side that the target's investors pretty quickly sell to the ARBs, let them deal with the deal completion risk and take the premium. But on the bidder side, it's more stable. I actually skipped one to get to there. So basically what I was saying before, I wanted to make it clear what I meant by median shareholder is that, there's a couple ways you can think of this, is that they might focus on what the median shareholder prefers, or they might focus on what any sort of relatively large block of shareholders preferred. You can think of weighting schemes where once you get to 20 or 30% of the shares, they might be loud enough that the managers might pay some attention to what's going on here. And so, as we talked about, whether they take this into account depends on exactly what's going on in their utility function and whether or not these shareholders with the cross holdings can make themselves influential. Okay, so just quickly on the data, it's relatively standard data. For the first part where we're looking at this stuff in general, we're just looking at the S&P 500 and then the next 100, 85, 95, 2005. We need CRSP and CompuStat data, and we need 13F data. The 13F is the required filing. If you manage $100 million or more of money in the U.S., you have to file quarterly this 13F form of the SEC, which outlines your holdings. And so we have those data. Then when we get into the acquisition part of it, then we switch over and we need a sample of acquisitions. So we switch over to SDC M&A database, and we go with everything announced, whether it was completed or not, between '84 and 2006. But these are only public acquisitions. So that's a minority of all deals, because there's a lot of private bidders out there, a lot of private targets out there, a lot more private targets out there. But we need them to both be public in order to sort of in order for there to be cross holdings. And so we end up with about 3,500 mergers and mergers attempts. And table 3 of the paper gives the summary statistics. All that table reveals is that it's a fairly typical sample of acquisitions. The acquirers are larger, doing better than the targets, fairly usual breakdowns and things.
Questions about sample 1. Is the sample 1 merger and acquisition events, or just simulate them?
No, sample 1 has nothing to do with mergers and acquisitions. So sample 1 is how important are cross holdings in the general population. And then sample 2 is let's look at a specific event, M&A, and let's see if they matter. Now, I think part of what your question is getting at is what do I mean by cross holdings in the general population? And so what we do is for every pair of firms in the S&P 500, so this is 500 times 500, minus whatever 500, we compute the cross holdings. And so this actually sort of brought a couple computers to their knees before we found one that could do this. Because whatever it is, 250,000 or something pairwise possibilities, and so literally, for every single one of those, we have to do this, create this map of cross holdings, and then pluck this off. And if IBM shareholders cross holdings in JP Morgan are different than JP Morgan's shareholders cross holdings in IBM, right? And so so we end up with a lot of different computations, but then we found a computer at Stanford that could do this. So we were happy. Oops, what happened here? That's weird. Okay. Yeah, okay. So in 1985, we still had 250,000 possible pairs, but we only had 191,000 pairs that had the institutional holdings data, and where institutional ownership was greater than 20%. So there were enough pairs where that wasn't true. That's why we don't have 250,000 observations here. And what we see is that even back in 1985, basically, in any potential pair, 1% of the base firm's shares were held by investors that had a lot more in the other. And that's of course the extremes. The median was still relatively low in the sense that if you're any randomly chosen firm in the S&P 500, your median shareholder only puts a weight of 6% on what your actions do to some other randomly chosen firm. Okay, so but there are at least 5% of the firms in the S&P 500 where the median shareholder would put a weight of about 31% on the sort of randomly chosen other firm. Where these, I should mention, when this number goes over 1, that's when your shareholder actually weights the other firm more than what they weight happens to your firm. Okay.
This is like that ratio of alpha A over B.
Exactly what it is, except that instead of bidder and target, we have firm A, firm B. Now, you start to see this rise as you get to 1995. It's going up here, and you see that you start to see that there's substantial fractions of firms where this is a big number, and that even in the average firm, 10% of your shares are held by shareholders who care more about another randomly chosen firm. And I'll talk about what I want to get out of this when I show you 2005. Okay, so by the time you get to 2005, what you see is that in the average firm in the S&P 500, 20% of its shares are held by investors that have a cross-holding of more than 1 in the average other firm. So what that means is that if you take some hypothetical dispute between two firms in the S&P 500, say it's a patent dispute, okay? If you're a manager in that dispute, 20% of your shareholders actually prefers that the other firm wins the dispute. Okay? So that's kind of where this stuff starts to get interesting. Yeah.
In terms of the indexing issue, I guess over time indexing has become more popular.
Right. So that's certainly part of what's going on here.
Right. Is this something that you can control for instance, if you have your institutional investors and you separate them into those that manage actively and those that manage passively?
Yeah, that's a good idea. We've been right now we've taken sort of the quick and dirty way to do this, which is we also compute all this stuff for the next 100 firms, the firms that are also large but are not mechanically in the most followed index, the S&P 500. And we get pretty similar numbers. The growth is similar. And this is mostly mirroring the growth in overall institutional management of money. But they're not as extreme. So this is more like at about 15% mark you get to the flipping point instead of the 20%. So you only have 15% of your shareholders who are rooting for the other side. And this number, instead of being 29%, is more like 18%. But we could do this stuff like Bushy has done, or where you split institutional investors into those that are sort of either outright indexers or quasi-indexers, right? They sort of just buy and hold versus more actively. It calls them indexers, quasi-indexers, and transient, or something like that. It turns out to be hard in the 13F database to just yank out index funds. You actually would have to go through and try to do it by name. There's no code for index funds. And and I think as your question kind of got at in terms of active versus not, some funds are sort of index funds even though they don't necessarily call themselves index funds. So we could try that to get at this issue as well. But this is generally framing the issue. Indexing is contributing to it. It's not the whole thing, but regardless, you end up with this sort of interesting situation where a substantial fraction of your shareholders actually prefer the other team to win. Okay, so what about those are the sort of the averages, and so what explains why one particular pair of firms has more cross holdings than another particular pair of firms? So our idea was fairly simple. I kind of talked about it earlier. Why would one institution hold more of this pair of firms than another set of firms? And they probably have some characteristics they're looking for, and so they tend to invest in similar firms. And so our idea here is that by any measure of distance, in terms of characteristics being different from each other, the two firms that are sort of more distant from each other should have lower cross holdings. Okay. And so we test this, and there's to make it sort of readable, I didn't reproduce every control variable in the specification, but the ones that are sort of the main variables of interest I put up here. The rest are in the tables in the paper if you want to see the whole specification. But we control for total institutional ownership. We control for total size, both of which are going to affect the cross holdings. But then, as you can see here, the further apart they are in terms of size, the lower are their cross holdings. And we just replicated here the top 20% and the median cross holdings. The more different they are in terms of market to book, the more different they are in terms of ROA, or the more different they are in terms of their stock performance, the lower are the cross holdings. So this sort of relatively simple idea does seem to hold true, that similar firms tend to be held by the same institutional investor. This also helps us as a first step later on when we're trying to decide, are cross holdings in M&A pairings unusual in some way, because we need to have a baseline of what sort of a normal amount of cross holdings would be. And so this having a model of what explains cross holdings helps us get there. Okay, so this is the part where I'm shifting gears. So everything up to now I've just been talking in general about cross holdings in terms of the data, and now I'm going to shift to the M&A sample, merger and acquisition sample. And so first we're going to basically compare what are the cross holdings in these bidder target pairs, and how do they compare in general, are they big, whatever. And then we're going to move on to say, okay, if cross holdings matter, then by any measure, because they're sort of quasi toeholds, by any measure or any theory of toeholds, they should make a particular target more attractive the higher is the median or top 20% cross holding that your shareholders have. And so we're going to conduct three tests. They're not independent tests. They're sort of different ways of trying to bracket the same question here. We're going to say, okay, here's a pair of firms that actually did have a merger announcement, the actual bidder target pair. And then we're going to basically say, well, that bidder could have chosen another otherwise similar firm, but it didn't. Similar on all these characteristics. And then we'll say, well, are the cross holdings in the one it chose higher than the one it didn't choose? And we'll do the sort of same thing in the sense that the target the target that ended up with this bidder could have ended up with a different bidder. And is that, so we've got otherwise similar bidders, otherwise similar targets. We've got the actual pairing and the other potential pairings, and we're asking, is the actual pairing the one that had the highest cross holdings?
I think that conceptualization of power is really interesting, because I'm still a little puzzled about this. I mean, I like the idea of similar firms. I got Dairy 1, Dairy 2, Dairy 3, or Print 1, Print 2, Print 3, a bunch of different firms. So I'm sitting here, firm 1, I'm thinking of taking over firm 2. And I mean, I might look at firm 3 as possible, but I reject that when I take firm 2. But surely, if my price is going down, my target's price is going up, what's happening to the price of the other guy?
Well, in terms of that, it could have been chosen.
Just imagine a three-firm industry.
Okay,
firm what happens to the share price of firm 3? And because that would be of interest to me if I was a shareholder and I had some cross holdings in firm 3. But I might be low in cross holdings in firm 2.
Okay, right. Okay, so yeah, all right. So there's the cross holdings in the sort of firm not chosen, and there are shareholders that are affected by the not chosen choice, just as they are affected by the right. Okay, no, yeah. Okay.
That's just the general equilibrium thing. James, like prices. Instead of looking at them pairwise, we got a bunch of different firms.
Depends how many comparable firms you've got, right?
Yeah.
There's only one other potential one, big difference.
Yeah,
200.
yeah. I mean, in your example, firm 3 is in trouble for many reasons.
Not if the new firm 1 and 2, the share price is going down.
Well, yeah, I mean, it depends on assuming under the assumption that 1 and 2 was a better competitor, but yeah.
You've got the information on the cross holdings and more than just the target.
Yeah.
All these other potential.
Right, we do. Okay.
Your dependent variable, well, whenever you talk about your measure of cross holdings, it's that A over B. For example,
Yeah.
2 over 5.
Yeah, right, okay.
So the weight that you put on the other one, which is less than 1 if you've got a greater holding than the bidder, and more than 1 if you've got a greater holding than the target.
Right.
Does it matter that you've got a very, very asymmetric variable? 0 to 1 means greater interest in the bidder, and 1 all the way to infinity means greater interest in the target. And you've also got a limited dependent variable because it can't go less than 0.
Right, you can't go less than 0.
If you take logs before you put it into the regressions.
We tried a bunch of stuff. I don't remember if we tried that to fix the distribution. So I'm going to just punt on your question then, because I don't remember us doing that, despite I remember us doing lots of different things to convince ourselves of what was going on here, but I don't remember us recognizing that fact explicitly, and it's potentially important. Thanks. Okay, so we have these. So we'll look at this, and this will just be sort of a control, sort of sample setting, and then we'll estimate our model of cross holdings similar to the one I just showed you, and show that if you throw in these two firms announced a merger, that positively explains cross holdings incrementally to these other characteristics, and then we'll kind of turn it around and estimate a model of target selection. This is sort of similar to this, but in a sort of more multivariate setting, and show that cross holdings can be used to predict target selection above the typical variables. Okay, so first of all, here the general. This is our sample, 1984 to 2006. As long as the bidder had institutional ownership greater than 20%, as I said, that's a pretty innocuous requirement because of the size of bidders that typically have institutional ownership of at least 20%. You see, this is kind of what we were talking about the not taking this too far in terms of the wealth effects, although I'll show you the wealth effects in a minute, is that the median cross-holding in the average bidder is only 6%. Okay. However, 5% or more of the bidders have a median cross-holding as high as 46%, and in the average bidder, 10% of its shares put a cross-holding of 80% on 20% of its shareholders. So there are indications here that cross-holdings are economically important in parts of the sample. In the average bidder, some portion of its shares are held by shareholders that have big cross-holdings, and in some bidders, even 50% of its shares are held by bidders by shareholders that have relatively large cross-holdings. When you look at how you kind of do that experiment I did at the beginning with Tribune and Times Mirror across the entire sample, you see the average 3-day cumulative abnormal return for the bidder is -1.5%. Now, the cross-holding sort of barely affects this for the median shareholder. It goes from -1.5% to -1.2%. It's not until you get to basically 20% of the shares that effect gets zeroed out, and you get into beyond that, you have this minority of the shares in the sort of 15% and more, or 15% or less of the shares are held by shareholders that actually do better in the deal because of this negative wealth effect is actually reversed because of their holdings in the target. So it is there, but it's in a fairly small part of the shares.
George, on the CAR,
Mm-hmm.
how did you adjust for returns?
This is just a market model. Yeah. Yeah.
My question is, since you use market model to estimation, and the observation is 3,014, and what's the software package do you use to run this kind of operation?
This is Stata. Stata.
Can run them simultaneously 3,000.
I guess I'm not sure I understand. So market model adjustment is I have, for each of these 3,000 bidders, I have a 3-day return, and I have a 3-day market return. And so this is sort of Brown and Warner stuff in the sense that over a 3-day period, the asset pricing model doesn't really matter. It's a small enough period that the announcement return will come out, whether you do a regression or whatever. And so I have market adjusted, which is bidder return minus market return. Add them up and take the average.
I think the question is, you got 3,000 plus firms, and for each of those firms, you're basically estimating a market model. And so how do you estimate 3,000 all with separate sets of regression coefficients? So how are you just from a practical perspective, it's a simultaneous system with 3,000 lines in it, but that's a big system. So is that how you're doing it? Or?
No. This is you can run this as so you have for every, these are the right markers, yeah. Okay. I've seen people pick up permanent markers before. So you've got the announcement day is so even if you're running a full-on market model, say this is the announcement day. Here's -1. Here's 1. There's two ways to do it. One is just sort of market adjustment, right? Which is just that the CAR IT is the return IT minus the market return IT. The other is to do a market model where, over, say, days, let's say days -250 to -20 to avoid any contamination, I estimate a market model for firm I. So I estimate, the return on IT is alpha times the return on the market for time t. And then I just take these coefficients and use, instead of using the market return, I have the predicted, right? But I run that separately for every firm.
So you just write a little do loop or something? Is that how you
Yeah, I mean,
you don't sit there and...
no. You just say Stata do it, or see, Kai is converting to Stata. Dirk's always been a Stata person. I'm still kind of more of a SAS person. So SAS does everything and basically in a loop. So you just tell SAS do this to the data set, basically, and it'll do it for every observation. And then you end up with these cars. So, but yeah, either SAS or Stata will do that without. Yeah, exactly. Yeah, somewhere in there, either you or the system is effectively saying, do this, 3,000 times, and then apply it here 3,000 times. Yeah.
This could even be programmed in Excel. It's not that big a deal.
Yeah, for this kind of relatively, simple model or whatever. Yeah.
But you were just using the market.
Yeah.
I was just wondering if the magnitude, obviously the significance won't be affected. Magnitude might be affected.
Oh, you mean if I do market adjusted versus market model?
I mean, I know Brown and Warner, but I think they were more concerned with the significance and the magnitude.
Right. They were more concerned with, are you going to get, are your tests still, are you still going to reject 5% of the time and so forth. Yeah. So if the average, if the average beta or beta isn't 1, this is going to be more off than that. And so, but is it going to affect? Right. So it might, if this was more negative than these numbers, it shouldn't affect the adjustment. But it's going to. Yeah, if this was off, it might affect where the switchover happened. But this is our main point isn't sort of precisely where the switchover happens as much as it is that it doesn't happen early enough for this to sort of explain bad mergers. It's not like once you do this, you see that half the shareholders in every merger are happy with it, right? So I'm running short on time. So this is kind of your question earlier, Jim, was about so one thing we wanted to check was the reverse causality. You hear occasionally of some activist type investors. They buy firm A, buy firm B, and then start agitating for them to get together. So we wanted to make sure that's not you hear stories about that, but is that really a big enough deal to affect what's going on? And going back 5 quarters, these cross holdings are pretty remarkably stable. So this isn't like the shareholders these cross holdings are appearing right before the merger, and that could be what's going on. Okay, this is sort of summarizing what I just said. Okay, so then the question is, are the cross holdings larger for firms that merge? Okay, and so like I said, we have the actual bidder target, and then we select a control bidder and a control target for each bidder target pair. And we match by industry size and total institutional ownership. So we're trying to control as closely as possible for those factors in this. And then we'll do a multivariate analysis where we try to control for other factors as well. And so what we have is we have 4 firms. There was 1 actual pairing, and then there were 3 other potential pairings that didn't happen. And so what we see is that in all cases, whether it's the top 1%, 5, 10, whatever, down to median, the cross holdings in the actual pairing are all greater than the cross holdings in any of the other potential pairings of the otherwise similar firms. So the actual bidder chose this actual target. They could have chosen this otherwise similar target, but it had lower cross holdings. So on the margin, it looks like the one with the higher cross holdings was chosen. Similarly, actual target could have gone to a different firm, but it had lower cross holdings than the actual pairing. And then the two firms that were otherwise similar but didn't merge at all also had lower cross holdings. Okay. Then we actually do it in a regression, and this is basically we take that model of what explains cross holdings, and we add to it dummies for, okay, these firms actually so the one that's missing here is the pair of firms that actually merged or actually announced a merger, and then we say, okay, basically here are the other possibilities, and you see that all the other possibilities are lower. So what this is saying is, since the one that's held out is the actual pair, is that all the other possibilities, even controlling for all of our control variables, had lower cross holdings than the ones that did merge. And then so summarizing this table, the cross holdings, which are in the intercept of the actual pair, are higher than any of the other possible alternative pairs, even after controlling for all these characteristics that affect cross holdings. We also control for total institutional ownership. So it's not just that institutions are buying firms that tend to merge, because we're controlling for total institutional ownership. There again is this possibility that we're missing some characteristic that's leading to institutions to hold this pair of firms and for this pair of firms to merge. But we've tried to pick every characteristic that's typically thought of as reasons why two firms would merge. So we could be missing something there, but like I showed back here, it would have to be a characteristic that they chose on a long time before the actual merger decision. And then our final analysis is, okay, let's flip it around and let's say, instead of does the actual pair have higher cross holdings, let's say if you're the bidder and I'm trying to predict which firm will be the target, can I predict which firm will be the target by ranking the targets by cross holding, basically, and saying the one with the greatest cross holdings is going to be the one that you pick as the target, all else equal. And in the table that you have, you can see all the other control variables we have for target selection, and we see that in all the cases, however we measure cross holdings, yes, the firm that has the higher cross holdings is more likely to be the one that you choose as the target.
So is this like the dependent variable here that you chose the target?
Yeah, the dependent variable is is that the firm it's like a 1 so this is like a logit,
So is it a logit?
I'm trying to remember if we ran it as a logit or probit. I think we ran it as a logit, but yeah.
Okay, so it's not like a multinomial type logit where you can choose all kinds of firms.
No, what we did was we went back to our actual bidder, actual target, control target, and we said, okay, now we have actual bidder, control target, actual target, and you're 1 if you're actual target, 0 if you're control target, and can we predict the 1? Yeah, and so basically the null percentage here is 50%. Basically if I flipped a coin, I would predict it 50% of the time. I think a 1 standard deviation swing in this in the median cross holding increases the probability by 9%. So you go from 50% likelihood of being chosen to a 59% likelihood of being chosen. Then there's of course all the other effects of the characteristics. And so a firm is more likely to be chosen. The greater are the cross holdings. Like I just said, a 1 standard deviation increases that by 9 percentage points. And so it appears, based on all this, that doing our best to control for other characteristics, that cross holdings incrementally predict who's going to be chosen as a target. That take a pair of firms, the ones that on the margin, the one that has the greater cross holdings is more likely to be the target. And so summing up, we started off by just talking in general about this effect of this indirect cross-holdings, and that there are these externalities created when you're dealing with having different shareholdings in different firms. Target selection is one place where we figured, okay, these are big enough that shareholders would care about it. We can actually measure the effect, and they should be relatively large. And so what do? We show that cross-holdings are economically important and growing in size. It's partially due to indexing, but it's not entirely due to indexing. And that that they are the greatest in firms that have similar characteristics. And then we showed that in an M&A setting, that it appears that managers do pay some attention to these cross-holdings in terms of which firms they select as targets. And that, I think, is all we say at this point. And I've stood between you and the drinks for an extra couple minutes. And thank you for your patience, but I would welcome any extra comments now or over drinks.
Any questions? Any plans on using the cross-holdings to explain other things like the patent fight you're talking about?
It's a good idea. We haven't pursued it except to say that my co-author Dirk presented this at sort of joint law and finance brown bag at Stanford, and when he mentioned that fact, like, the law guys got really interested all of a sudden. This sort of large fraction of the shareholders that are sort of rooting for the other side, and so we've been sort of focused on this part, but yeah, it seems like there's lots of other areas where this potentially has some bite. Yeah, Bob.
So there's no weighting here by the size of these deals?
We played around a little bit with that. Madvos and Ostrovsky look only at the 100 largest deals. And it turns out that whether by design or by happenstance, those are the deals where these cross-holdings are the largest and most likely to be able to explain a little bit of what's going on. We look at 3,000 deals.
Does it make sense if you look at the size of the deal and you think there's a fixed cost of being able to influence management, then obviously the larger the deal and talk about percentage here, the larger the dollar value of return in some sense of
right. So we've done a little bit of that, playing around with sort of requiring the target to be 5% of the bidder value or 10% of the bidder value, which, it's still that's not a huge cutoff, but. And we didn't find anything there, but we probably could. I guess it's maybe if we start looking at things that are sort of in the merger of equals range, we might start to. That would be where you think it would be sort of really big, right? That the effects would start to.
Or just in your probit model, this is really back to the envelope, I think, but if you interacted the crossover somehow by size of firm.
Okay. Yeah.
Or size of the deals, right?
Okay. Thanks. Yeah.
I'm just trying to think the takeaway I've got is that if you got high cross holdings by your shareholders, then if you target firm, then it's more likely to be taken over than if they hold shares. Okay? And then I was thinking, well, and then you're saying if you control for all the relevant sort of things, and I was just wondering, is it possible there's sort of something like managerial effort? But I want to think of effort as it's really difficult to observe, to measure, but it's really their kind of aggressiveness, And basically, you're a shareholder and you're thinking, wow, these guys are aggressive in this firm over here. These managers, they're always outgoing, taking over targets, and so I'm going to diversify my shareholdings across lots of different firms, and then I go to the passive guys, and I'm just we won't have such great diversification. And so in some sense, I'm just trying to think about puzzling, but it's also.
So you sort of know. Okay, so you basically you're saying, look, I'm going into this knowing that these guys are likely to make a bid, so I should sort of try to play the potential targets. Whereas if I'm in a firm that's not going to show up as a bidder, I can just be more concentrated.
Kind of like there's an unobserved variable that might say, well, they effectively got is spurious because the real driving thing is these animal spirits of the managers that you can measure. I mean, that's just a thought.
That will be the case only if you can observe that they're that type if you're one of their shareholders.
Right.
Otherwise you should just be buying people who are likely to be targets. That's only going to work if
Right. Yeah. You would always prefer to only hold targets. Right. Yeah. So, but we haven't figured that one out yet. But, and if we did, we wouldn't publish it right away.
Other questions?
All right. Well, thanks very much.
Before we go to the staff club.